The market is currently closed as of Saturday, April 18th, 2026, so we are looking at the final figures from yesterday's session. Opendoor Technologies, trading under the ticker OPEN, finished the day on Friday, April 17th, at a price of 5.29. This represented a modest gain of 0.38% for the day, but the real story is in the volatility we saw throughout the session, with the stock swinging between a low of 5.22 and a high of 5.52. While a 4-cent move might look like noise on a larger chart, for a stock at this price point, that 3% intraday range tells us exactly where the battle lines are being drawn between the bulls trying to reclaim the $5 handle as a floor and the shorts who are betting the recent rally is out of steam. The expectation right now is that Opendoor is finally finding its footing after the brutal housing freeze of the last few years, but the reality is much more complex and potentially more explosive than a simple recovery story. While the average retail investor is looking at interest rate cues from the Fed to decide if they should buy real estate stocks, the big money is looking at something entirely different, the Opendoor 2.0 operational pivot. This isn't just a company waiting for mortgage rates to drop. They are fundamentally changing how they buy and sell houses to protect themselves from the very volatility that almost wiped them out in 2022. If you are only watching the headlines about home sales volume, you are missing the internal engine swap happening under the hood. We are seeing a massive shift in institutional conviction that hasn't quite hit the mainstream narrative yet. For instance, Morgan Stanley recently disclosed a stake of over 10% in the company. That is a significant vote of confidence in a business model that many skeptics left for dead. When you see names like Vanguard, Renaissance Technologies, and even Citadel building positions, it suggests that the smart money is seeing a path to profitability that isn't dependent on a perfect housing market. They are betting on the platform's ability to price risk better than a local real estate agent can. This institutional accumulation is the quiet force behind the recent climb from the 52-week lows, and it provides a cushion that simply wasn't there 6 months ago. Looking at the recent price action, Open has been on a tear, surging nearly 10% in just the last few days of trading. This was fueled by the announcement of their first quarter 2026 earnings date, set for May 7th. But it wasn't just the date that got people talking, it was the format. They are moving to a live stream open house style for the results, which signal a management team that is confident enough to take live questions in a public forum. This transparency is rare in the iBuying space. Furthermore, reports have started circulating that weekly home purchases under new CEO Kaz Nejatan have surged by roughly 500% compared to previous lows. That is a staggering acceleration in inventory acquisition, which is the lifeblood of this business. The tension here lies in the unit economics. The market narrative says that iBuying is a flawed concept because you can't flip houses at scale when prices are flat. The reality we are seeing in the data is that Opendoor has significantly reduced the number of homes sitting on their books for more than 120 days, dropping that figure from 55% to about 33%. They are getting faster, leaner, and more surgical with their offers. They even introduced a new cash now, more later incentive model, which essentially allows them to share the upside with the seller, which reduces Opendoor's initial capital outlay and risk. It's a clever way to keep the pipeline moving without overextending the balance sheet. If you are using an online investment platform or a self-investing tool like the Robinhood app or SoFi Invest, you've likely noticed Opendoor popping up on the most active lists lately. This high volume is a double-edged sword. It shows liquidity and interest, but it also makes the stock a target for short-term traders. On the Interactive Brokers platform, we've seen a spike in options activity that leans slightly bearish, suggesting that while the long-term believers are buying shares, the professional traders are hedging for a potential pullback after this 20% year-to-date run. It's a classic tug-of-war between fundamental turnaround hopes and technical overbought signals. Despite the recent optimism, Opendoor remains a deeply loss-making enterprise. This is the reality that keeps the bears in the game. Analysts from firms like Citigroup and KBW still have underperform ratings on the stock, with price targets that are frankly quite pessimistic compared to where we are trading today. They argue that the company is still burning the furniture to keep the house warm. However, the contrarian view is that these analysts are using a rearview mirror. They are looking at the massive losses of 2023 and 2024, rather than the narrowing net loss projected for the back half of 2026 and into 2027. If you're managing your own individual brokerage account or using something like Schwab Intelligent Portfolios, you have to weigh these risks carefully. Opendoor isn't a set-it-and-forget-it blue chip. It is a high beta play on the digitization of the largest asset class in the world. Whether you're using Fidelity Wealth Management Services or just poking around for investment help on various investing sites, the consensus is shifting from will they survive to how big can they get. The company's tech stack has been simplified, and their pricing models are now incorporating more macro indicators in real time. This means they aren't just guessing what a house will be worth in 3 months. They're using data to spreads that protect their margins even if the market dips.
Now, let's step back and look at what this company actually does for the uninitiated. Opendoor is the pioneer of iBuying. In simple terms, they act as a market maker for residential real estate. Instead of a homeowner listing their property, waiting for an offer, and dealing with inspections and financing contingencies, Opendoor makes an instant all-cash offer. They then take ownership, do light renovations, and list the home for sale. They make their profit on the spread between the buy and sell price, plus a service fee. It sounds simple, but the logistics of owning thousands of homes across dozens of markets are incredibly complex. In the past, they got caught with too much inventory when interest rates spiked, forcing them to sell at a loss. The current version of the company is trying to prove they can handle a high-rate environment by being more selective and efficient. The broader housing market in 2026 is finally showing signs of a rebalance. According to the latest data from the National Association of Realtors, inventory levels are up about 20% from a year ago. This is a welcoming development for Opendoor. A market with more choices and less panic buying actually plays into their hands. When buyers aren't in a desperate rush, they value the certainty and convenience of an Opendoor sale. The lock-in effect where people refuse to sell because they have 3% mortgages is also slowly fading as life events, marriages, kids, new jobs, force people to move. This deferred demand is like a coiled spring, and as mortgage rates stabilize or tick down, Opendoor is positioned to be the primary liquidity provider for that release. Comment below how many shares of Opendoor you currently hold, or if you're still sitting on the sidelines waiting for the Q1 earnings report. It's interesting to see how retail sentiment on the Robinhood app compares to the institutional moves we see on the Fidelity trading platform. The institutional interest we're seeing, especially from Morgan Stanley and SRX Health Solutions, is a sign that the market is beginning to value the platform as a technology play rather than just a real estate company. If they can successfully automate the appraisal and closing process, they could theoretically license that tech to others or expand into ancillary services like title and escrow, which carry much higher margins than flipping houses. This is where the long-term bull case gets really interesting. If they become the Amazon of houses, the current $5 share price will look like a historical anomaly. However, we have to talk about the risks. The stock is currently facing heavy technical resistance near the 550 mark. We saw it hit that level on Friday and then pull back slightly. If it can't break through that ceiling with high volume on the next earnings call, we could see a retreat back toward the 450 support zone. Additionally, the company is still heavily reliant on debt to fund its home purchases. While they have improved their capital structure, any sudden spike in credit spreads or a tightening of the repo markets could squeeze their ability to buy new inventory. This is why many cautious investors prefer using Fidelity ETFs or Fidelity mutual funds to get broader real estate exposure, rather than betting on a single volatile name like Open. The comparison to Carvana's turnaround is a popular one among the bulls. Just as Carvana survived a near-death experience to become a leaner, more profitable machine, the hope is that Opendoor has finished its trial by fire. The reality, however, is that houses are much harder to move than cars. You can't just truck a house to a different state where demand is higher. You are stuck with the local market conditions. This geographic risk is something the company is trying to mitigate by focusing on high-growth Sunbelt markets, but it remains a persistent vulnerability. As we look toward the May 7th earnings, the expectation is a revenue figure approaching $1 billion for the quarter. If they beat that, and more importantly, show that their contribution margins are holding steady or improving, we could see a massive short squeeze. There is still a significant amount of short interest in the stock, as many traders are still betting on the iBuying is dead narrative. If the reality of the 1Q number shows 500% growth in acquisitions with stable margins, those shorts will be forced to cover, potentially sending the stock toward the double digits. To wrap this up, the story of Opendoor in early 2026 is one of a company that has survived its worst-case scenario and is now reinventing itself for a new era of real estate. The expectation was that high interest rates would kill this business model, but the reality is that the company has used this period to harden its tech, refine its pricing, and attract some of the biggest institutional names in the world. Whether you're using the Interactive Brokers platform for sophisticated trades or just doing some online investing via SoFi or Robinhood, the volatility in Open makes it one of the most compelling stories in the market right now. The contrast between the cautious analyst consensus and the aggressive institutional buying creates a massive opportunity for those who can correctly predict which side will be proven right. We are at a pivotal moment, well, a crucial juncture, where the next few months will determine if Opendoor is a permanent fixture of the housing market or just a high-tech casualty of the interest rate cycle. The authority of their Opendoor 2.0 strategy is about to be tested, and the results will likely move the entire real estate sector. Keep a close eye on that 550 resistance level and the upcoming open house livestream. These are the catalysts that will tell us if the recent rally is the start of a multi-year recovery or just a bear market trap. For now, the smart money is voting with their wallets, and they seem to think the reality is much brighter than the headlines suggest. The depth of this analysis shows that beyond the daily price fluctuations, there is a fundamental shift in how the market perceives risk in the real estate space. Whether you're looking for investment help or managing a self-investing portfolio, Opendoor is a name you cannot afford to ignore as we head into the heart of 2026. Stay grounded, watch the data, and remember that in the stock market, the gap between what everyone expects and what actually happens is where the real profit is made. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts. outshare with your friends. Subscribe for more updates.